As we enter the final days of January 2026, the machinery of American wealth sits exposed in ways not seen since the months before prior systemic failures. The Federal Reserve meets tomorrow against a backdrop that combines institutional pressure unprecedented in modern central banking history with market structures that have mathematically priced themselves into corners from which there may be no elegant exit. This is not speculation about what might happen. This is documentation of processes already unfolding, pressures already applied, and mathematics already determining outcomes that most participants refuse to acknowledge until the moment of recognition becomes unavoidable. I'm not a financial advisor. This isn't financial advice. This is an educational analysis based on publicly available information and historical precedent. The criminal investigation of Jerome Powell announced on January 11th represents something far more consequential than a political spat over building renovations. Federal prosecutors served the Federal Reserve with grand jury subpoenas, threatening criminal indictment over Powell's June testimony to Congress regarding the central bank's headquarters renovation project. Powell himself issued an extraordinary video statement characterizing this as intimidation tied directly to his refusal to cut interest rates, according to presidential preferences rather than economic evidence. The investigation centers nominally on a $2.5 billion renovation, but Powell stated explicitly that these are pretexts, that the threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on their assessment of what serves the public rather than following the preferences of the president. Treasury Secretary Scott Bessent reportedly expressed concern that the investigation would negatively impact markets, though initial market reaction proved muted. Republican senators, including Tom Tillis, pledged to oppose any Fed nominations until the matter is resolved, while bipartisan former Fed chairs and economists compared the administration's actions to tactics seen in less developed economies. Powell's term as chair ends in May, though his term as governor extends to January 2028, and analysts now suggest he may remain on the board specifically to defend institutional independence rather than departing as previously expected. The timing matters immensely. JPMorgan Chase revised its Federal Reserve outlook on January 13th, now expecting 0 rate cuts in 2026, followed by a 25 basis point hike in the third quarter of 2027. This represents a complete reversal from their previous forecast of a January cut. JP Morgan's chief U.S. economist, Michael Feroli, noted that the proposition that rates are restrictive looks increasingly untenable given economic and financial developments, adding that if the labor market weakens or inflation falls materially, the Fed could still ease, but they expect the labor market to tighten by the second quarter and disinflation to be quite gradual. The bank explicitly acknowledged that the interest rate outlook could hinge on the Fed's ability to maintain independence in the face of growing political pressure. Options traders have increasingly priced out expectations for any Fed rate cuts in 2026, with positions centered around March and June, hedging a scenario of continued delays, while other positions targeting further out stand to benefit from a Fed-on-hold stance, with rates remaining in the current 3.5 to 3.75% band through year-end. A JP Morgan survey of client positioning during the week ended January 12th showed short positions rising 4 percentage points and longs increasing 3 percentage points, resulting in the least net longs since October 2024 and the most outright shorts since October 6th last year. The Federal Reserve itself signaled only one additional rate cut for 2026 in its December 10th meeting, maintaining its target range at 3.5 to 3.75% after cutting by a quarter point. The meeting saw unusual dissent, with interim Governor Stephen Miron favoring a larger 0.5% cut, while Governors Schmid and Goolsbee preferred no change at all. Outside the 12 voting members, 4 within the total 19-member FOMC body, who submit projections elected for no cuts, several of whom may rotate onto the committee this year. The December statement adjusted language stating in considering the extent and timing of additional adjustments to policy rates, suggesting reduced certainty about future moves. Powell described policy as meaningfully restrictive and noted that by many measures, equity prices are fairly highly valued. Comments made before markets climbed even higher into January. The January 27th to 28th meeting occurs against this criminal investigation backdrop, with economists suggesting the Fed will likely avoid cuts specifically to demonstrate it cannot be pressured by politics, even as economic conditions might otherwise warrant easing. This creates a trap with historical precedent. When central banks face political pressure to ease while simultaneously needing to prove independence, they tend toward hawkish positioning regardless of economic data, a dynamic that has preceded rather than prevented crises in multiple historical episodes. The political capture of monetary policy does not require formal control, merely the credible threat that independence will be punished, which shifts the incentive structure for decision makers in ways that distort optimal policy responses. The investigation of Powell essentially creates a situation where the Fed cannot cut rates without appearing to capitulate to pressure, yet cannot maintain restrictive policy indefinitely without risking the very economic deterioration that might justify cuts, except by that point, cuts may prove insufficient to reverse momentum. This is a classic double bind where both available options lead to suboptimal outcomes. The wealth destruction mechanism operates through several converging channels. JPMorgan expects the 10-year Treasury yield to climb to 4.35% by year-end 2026, placing them among more bearish forecasters compared to the Bloomberg survey median of 4.06%. Their analysis suggests Treasuries are unlikely to replicate this year's strong performance because markets have priced in too many Fed rate cuts that will not materialize. Higher long-term yields directly reduce the present value of all future cash flows, mechanically lowering equity valuations even if earnings remain constant. For growth stocks that rely on debt to fund expansion, higher capital costs imposed by rising yields represent a substantial burden that compresses profit margins and slows investment. The stock market currently trades at a forward price to earnings multiple of approximately 22, according to FactSet Research, elevated not only compared to the index's 5-year and 10-year averages, but historically high in general, with the only comparable periods being the dot-com bubble and the months before the 2008 crisis. The S&P 500 Shiller-Cape ratio, which accounts for corporate earnings over a 10-year period adjusted for inflation, sits at historically extreme levels. The Buffett Indicator, measuring total U.S. stock market capitalization to GDP, recently reached approximately 234%, its highest level ever, far exceeding the 200% threshold that Warren Buffett described in 2001 as playing with fire. These valuation metrics do not predict exact timing, but they do constrain mathematical outcomes. When valuations reach extremes, future returns become mathematically limited because there is simply less room for multiple expansion, meaning returns must come entirely from earnings growth, and if earnings disappoint even modestly, the valuation compression can be severe and rapid. Research from Natixis Investment Managers surveying 515 institutional investors controlling nearly $30 trillion found that 79% of North American institutions expect a market correction in 2026, with 49% seeing a 10 to 20% decline and 20% anticipating a steeper drop. S&P 500 put option prices indicate an 8% chance of the market dropping at least 30% during 2026 based on December data. These are not fringe predictions, but consensus expectations among the largest institutional capital allocators, who nonetheless expect 8.3% returns because they must remain invested regardless of their own conviction about downside risks, a dynamic that itself creates fragility. The concentration risk amplifies systemic vulnerability. Harvard economist Jason Furman calculated that U.S. GDP growth in the first half of 2025 was almost entirely driven by data center spending as technology companies amassed high-end graphics processing units for artificial intelligence applications. This represents a single narrow sector responsible for the majority of apparent economic expansion, creating dependency on continued AI investment that may not produce returns justifying the capital deployed. Multiple economists who correctly predicted prior crashes, including Dean Baker, who warned of the late 1990s stock bubble and the mid-2000s housing bubble, now express concern that AI spending represents another instance of speculation dressed as innovation, where the gap between investment and returns widens until recognition forces repricing. If sentiment toward AI sours, which could occur if major companies like OpenAI go public and reveal the questionable unit economics behind generative AI services, the correction would not be isolated to tech stocks, but would cascade through the broader market given that AI exposure extends across banks, healthcare, logistics, utilities, and numerous other sectors that have repositioned around the theme. Consumer spending dynamics reveal dangerous fragmentation. Aggregate spending remained strong through 2025, but this strength came entirely from the highest income consumers. According to data from the Federal Reserve Bank of Boston, spending by middle-income and lower-income consumers has stagnated, while Moody's reports that the top 10% of earners are now responsible for almost half of U.S. consumer spending. This concentration means the overall economy is considerably more fragile than top-line data suggests, because consumption that represents 70% of GDP now depends on the continued wealth effect experienced by a narrow slice of households whose portfolios have appreciated. When those portfolios correct, which high valuations make mathematically probable at some point, the wealth effect reverses and the spending it supported contracts, which then feeds back into corporate earnings that disappoint relative to expectations built during the boom, which then accelerates the correction in valuations. This is the mechanism that transformed the 1929 crash from a financial event into an economic depression. And it is the mechanism that connected the 2008 housing collapse to broader economic contraction beyond the financial sector. The political and policy environment introduces additional tail risks that were not present in prior cycles. The Supreme Court will decide in 2026 whether the White House had authority to enact reciprocal tariffs, and if they rule against the administration, the U.S. could be forced to refund hundreds of billions in collected levies, potentially causing investors to reevaluate the country's fiscal condition. Higher perceived sovereign risk translates to higher yields on treasuries, which raises capital costs throughout the economy, imposing burdens particularly on growth stocks that operate on thin or negative margins sustained by cheap financing. The case regarding President Trump's attempt to fire Fed Governor Lisa Cook for alleged financial improprieties will be heard in January, with a ruling expected by mid-2026. And a legal victory for Trump could undermine confidence in Fed independence, which itself represents a risk premium being built into markets, according to Schwab's chief fixed income strategist. Government shutdowns remain a recurring threat, and a second shutdown could throw collection of jobs, inflation, and other economic data into chaos, potentially damaging U.S. credit ratings and scaring investors away from U.S. assets. These are not hypothetical scenarios, but scheduled events and ongoing dynamics whose resolution carries significant market implications. The retirement account structure through which most Americans hold wealth creates a specific vulnerability that differs from prior crashes. 401k accounts held an average balance of $144,400 in the third quarter of 2025, according to Fidelity, reflecting stock market gains and consistent contributions. For 2026, contribution limits increased to $24,500, with an $8,000 catch-up for those 50 and older, and new rules require high earners making over $150,000 to make catch-up contributions to Roth 401k accounts rather than traditional accounts, increasing their current tax burden. These accounts are overwhelmingly invested in target date funds and index funds that mechanically track the market, meaning when the market falls, these accounts fall in lockstep with no active management to reduce exposure. The concentration in passive vehicles that was not present in prior decades means price discovery becomes impaired during stress because index funds must sell proportionately across all holdings, regardless of fundamental value, accelerating declines through mechanical rather than informed selling. Michael Burry, who predicted the housing crash, has specifically highlighted passive investing's popularity as a systemic risk because it creates conditions where many stocks fall together rather than differentiating based on business quality. What makes this moment particularly dangerous is the convergence of multiple normally independent risk factors arriving simultaneously. Political pressure on the central bank coincides with extreme valuations, which coincide with concentrated consumer spending, which coincides with concentrated equity exposure to a single investment theme, which coincides with policy uncertainty around trade and fiscal matters, which coincides with mechanical market structure through passive investing, which coincides with transition in Fed leadership under contentious circumstances. Each factor alone creates manageable risk. The simultaneous presence of all factors creates a system where there is no shock absorber, no independent variable that can stabilize when others destabilize. This is the definition of systemic fragility, where the system itself, rather than any particular component, becomes the source of risk. History offers clear guidance on outcomes from such configurations. The 1929 crash occurred when valuations reached extremes, when wealth concentration meant spending depended on a narrow group, when the Federal Reserve faced political pressure and responded poorly to maintain its credibility, when financial innovation had created mechanical selling through margin calls, and when policy responses proved inadequate to reverse momentum once it turned. The 2008 crisis occurred when valuations in a specific asset class reached extremes, when mechanical instruments like credit default swaps amplified selling pressure, when the Federal Reserve initially failed to appreciate systemic rather than isolated risk, and when the interconnection of financial institutions meant localized problems became universal. The current configuration contains elements of both prior episodes plus new factors like passive investing concentration and direct political pressure on central bank leadership that were not present before. The combination suggests not just that a crash is possible, but that the architecture is already in place, requiring only a catalyst to reveal what has already been constructed. The timing mechanism likely operates through one of several possible triggers. An AI company going public and revealing poor unit economics could shift sentiment suddenly. A policy shock, like the Supreme Court overturning tariffs, could change fiscal arithmetic abruptly. A weaker than expected earnings season could expose the gap between valuation and reality. A geopolitical event could shift risk appetite rapidly. An unexpected inflation print could force the Fed into a rate hike that markets are not positioned for. A liquidity event in credit markets could propagate through the system, or simply the passage of time allowing more market participants to recognize the same valuation extremes that institutions already acknowledge, could create enough selling pressure to begin a self-reinforcing decline. The specific trigger matters less than the fact that the system is positioned such that any trigger can start a cascade, which is the defining characteristic of fragile systems approaching transition points. The political calendar reinforces rather than mitigates these risks. Midterm election years historically see the S&P 500 return an average of only 1% excluding dividends, well below the 9% annual average since 1957. Because policy uncertainty peaks as the political party of the president tends to lose seats in Congress, creating questions about whether the economic agenda can continue. The 6 months before midterm elections are typically weak, while the 6 months after are typically strong. But this pattern depends on uncertainty resolving rather than intensifying, which may not occur if the Fed leadership transition becomes contentious, if the Supreme Court cases generate unexpected outcomes, if trade policy remains in flux, if government shutdowns recur, if the criminal investigation of Powell escalates. Policy uncertainty that fails to resolve creates sustained rather than temporary market weakness. The Federal Reserve meeting tomorrow takes place in this context. Markets expect the Fed to hold steady, but the very act of holding steady while inflation remains above target and while facing political pressure to cut creates its own dynamics. If the Fed holds to prove independence, markets may interpret this as prioritizing institutional credibility over economic conditions. If the Fed cuts, markets may interpret this as capitulating to pressure, which undermines confidence in future decision-making. If the Fed signals confusion or division, markets may lose confidence in policy coherence. There is no obviously correct action that restores confidence in all dimensions simultaneously, which is precisely the situation that precedes rather than prevents crises. The wealth destruction, when it comes, will feel sudden to most participants, but it has been mathematically determined by the positions taken, the valuations reached, the leverage applied, the concentration achieved, the mechanical structures implemented. The 401k accounts holding American retirement security will decline in value not because of something participants did wrong, but because of systemic positioning they had no ability to control or even perceive. The perception of safety through diversification in index funds will prove illusory when index funds themselves become the transmission mechanism for selling pressure. The belief that time in the market beats timing the market, which is generally valid across long periods, will be tested by those who must sell during the drawdown to meet living expenses or who cannot psychologically tolerate watching their lifetime savings decline by 30 or 40 or 50%, even if eventual recovery is probable. The mathematics are clear even when the timing remains uncertain. Assets priced at historically extreme multiples of earnings cannot continue appreciating at double-digit rates without earnings growth that exceeds all historical precedent. Earnings growth that depends on narrow sectors cannot persist without broad-based economic expansion. Broad-based expansion cannot persist when consumer spending concentrates among a narrow wealth group. Wealth concentration cannot persist when the assets creating that wealth face valuation compression. Central banks cannot ease meaningfully when facing political pressure to demonstrate independence. Markets cannot ignore indefinitely the gap between price and value. Systems cannot maintain stability when all shock absorbers activate simultaneously in the same direction. These are not predictions about what might occur, but descriptions of what must occur eventually for internal consistency to return to relationships that have become mathematically inconsistent. What distinguishes this moment from normal market volatility is the specific combination of maximum valuation, maximum concentration, maximum political pressure on monetary policy, and maximum mechanical market structure risk, all arriving together at the start of a midterm election year with Fed leadership in transition and multiple Supreme Court cases pending and ongoing trade policy uncertainty and deteriorating fiscal conditions and weakening labor market support for middle and lower income consumers, and extreme positioning in passive vehicles, and institutional expectations of correction despite continued deployment of capital. This is not a market that gradually became expensive. This is a market that reached extreme valuations while simultaneously building fragility across every dimension that historically has mattered for stability. The construction phase is complete. Tomorrow's Fed meeting is simply another brick being placed in a structure that cannot support its own weight indefinitely, regardless of how carefully each individual brick is positioned.